Overnight, while most of the world was asleep, silver did something markets are never supposed to do. It didn't climb. It didn't rally gradually. It gapped. One moment, silver was trading comfortably below key resistance levels, and the next moment, it reappeared at $75, leaving a vacuum behind it. No smooth transition, no orderly discovery. It's just a violent price displacement that stunned traders, rattled banks, and exposed cracks that had been quietly forming for years. This was not retail hype. This was not a meme rally. This was structure breaking in real time. When a market gaps, it's not excitement, it's panic. And panic always has a reason. Tonight we're uncovering why this gap happened, was caught off guard, and why this move suggests that the path to $100 silver may no longer be theoretical. What you're about to hear isn't noise. It's the signal hiding beneath it. Welcome back to Boring Silver Mystery, the channel where the most important moves in the silver market happen quietly before the headlines catch up. What unfolded overnight wasn't just another volatile session, it was a structural shock. Silver jumping to $75 in a single gap tells us something fundamental has changed. Gaps don't occur in healthy, well-supplied markets. They happen when liquidity disappears, sellers vanish, and the system fails to smoothly match buyers with metal. In this video, we'll break down what caused this gap, why it matters far beyond a price chart, and how this move fits into a much larger wave that could carry silver toward $100 sooner than most expect. This isn't speculation. This is market mechanics revealing themselves under pressure. A price gap is one of the most misunderstood signals in financial markets, especially in silver. When silver gaps higher, it means transactions that should have occurred at lower prices simply didn't happen. Sellers either stepped away or were unable to deliver. Why it matters far beyond a price chart, and how this move fits into a much larger wave that could carry silver toward $100 sooner than most expect. This isn't speculation. This is market mechanics revealing themselves under pressure. A price gap is one of the most misunderstood signals in financial markets, especially in silver. When silver gaps higher, it means transactions that should have occurred at lower prices simply didn't happen. Sellers either stepped away or were unable to deliver. Something physical broke beneath the surface, and when that happens, price moves violently to re-establish balance. The most important detail is this. Gaps don't close easily when they re-driven by structural shortages. They expand. The overnight jump exposed a dangerous reality: there simply weren't enough sellers at lower levels. Bullion banks, refiners, and large holders who typically provide liquidity were either unwilling or unable to step in. Some were already committed elsewhere. Others were protecting inventory. This created a vacuum where buyers chased price upward until resistance finally emerged. In silver, sellers disappearing is more alarming than buyers rushing in. It suggests inventory stress, delivery risk, or strategic withholding. When large players step back simultaneously, it often means they see higher prices ahead and refuse to sell into what they believe is an undervalued market. This dynamic transforms silver from a traded asset into a hoarded one, and hoarding is how markets become unstable. Once sellers retreat, price discovery accelerates upward, and the move feeds on itself. Paper silver markets are designed to smooth volatility, but only when physical supply is stable. Overnight, that illusion cracked. Futures contracts can be created infinitely, but physical silver cannot. The gap to $75 strongly suggests that paper sellers were overwhelmed by demand that ultimately ties back to physical delivery expectations. When confidence in paper settlement weakens, participants rush to secure exposure before rules change or premiums explode. This disconnect between paper price and physical availability has been widening for months, and the gap represents the moment the paper market lost control. Once physical stress leaks into pricing, suppression mechanisms fail rapidly. This is how silver historically transitions from managed to explosive. Overnight markets are thinner, quieter, and more vulnerable. That's why critical breaks often happen there. Liquidity is limited, fewer participants are active, and algorithms dominate order flow. When demand hits suddenly, there's no cushion. The silver gap wasn't random, it was inevitable under these conditions. Large orders entered a market that couldn't absorb them smoothly, forcing repricing. The fact that this happened overnight suggests the move wasn't emotional retail buying, but institutional positioning. Institutions move quietly, strategically, and often when visibility is lowest. The timing alone tells us this was not accidental. $1.75 is more than a number. It's a psychological and structural breakpoint. Above this level, decades-old models begin to fail. Hedging assumptions break down. Risk managers panic. Margin requirements adjust. The silver market isn't prepared for sustained trade at these levels. Overnight, silver didn't test $75. It claimed it. Once a market accepts a higher range without resistance, it signals that price memory below becomes irrelevant. Traders who waited for pullbacks may never get them. This is how vertical moves begin. For years, $100 silver was dismissed as fantasy. Overnight, that narrative cracked. If silver can gap to $75 without warning, the remaining distance is psychological, not structural. The same forces that caused this move, inventory stress, physical demand, and paper market fragility, don't stop at round numbers. Historically, once silver breaks into a new regime, it overshoots violently. $100 isn't a target, it's a consequence. The market doesn't care whether participants believe in it. It moves based on pressure. Banks are now trapped between paper obligations and physical reality. Rising prices increase margin stress, delivery risk, and counterparty exposure. Overnight gaps are nightmares for risk desks because they remove the ability to adjust positions gradually. If silver continues higher, banks may be forced to cover aggressively, adding fuel to the move. This is how controlled markets become uncontrollable. The system was built assuming silver would remain manageable. That assumption is now under threat. Retail investors often arrive late, but this time is different. The overnight gap wasn't driven by social media, it was driven by structure. That means the move isn't finished. Volatility will increase, pullbacks will be violent, but the direction is now dictated by scarcity, not sentiment. Understanding this prevents emotional decisions. This is not about chasing price, it's about recognizing regime change. Many compare this moment to 2011, but the structure is entirely different. Back then, inventories were healthier, paper markets stronger, and global demand lower. Today, silver is consumed industrially at record levels, while investment demand accelerates. The gap to $75 reflects cumulative pressure that has been ignored for years. This isn't a spike, it's a release. Markets rarely move in straight lines, but they do move with intent. The overnight gap marks a transition from accumulation to repricing. Future sessions may be chaotic, but chaos favors momentum when supply is constrained. Silver has entered a phase where price will search aggressively for equilibrium, and that equilibrium may be far higher than most models allow. Watching inventory flows, premiums, and delivery data will matter more than charts alone. The overnight gap to $75 wasn't excitement, it was a warning. It told us sellers vanished, liquidity failed, and the system blinked. These moments don't happen often, but when they do, they redefine markets. Silver is no longer behaving like a controlled asset. It's behaving like something that's running out. If you want to understand what the silver market is doing before the headlines, you're in the right place. Subscribe to Boring Silver Mystery, stay alert, and remember, market shocks don't announce themselves. They appear overnight, leave gaps behind, and never look back.